summary of what our listeners and viewers should think about trillions potentially exiting money market funds?
Yeah, it's a question, Tom, of how much actually can move. Certainly money market funds can lose a lot of the assets they have currently, and it's been a very attractive spot for a lot of people. 5% plus sounds great, right? So yeah, for the first time in a generation, cash has actually been viable. So we do think some of that cash is going to exit, but it's going to be a fairly methodical process. I think people tend to chase return. There's no mystery in that, but when you look at the S&P performance last year and then try to use that as a template for this year, I suspect most people are wondering about that. So we think the process is going to be fairly slow. It gets a push when the Fed eventually cuts, because then you can say, whoa, I may not get that 5% much longer. I should lock in something better.
Is the Fed behind? I mean, that's the heart of the matter here. I mean, I was making a joke about a January rate cut. People took me seriously. But Mike Schumacher, is the bottom line as an ex-post institution that they're behind right now?
I'm not sure the Fed's behind, but I think the big thing, Tom, here is that you just can't tell if you're a central banker. No one has seen this environment before. Not me, not you, not Jay Powell, not Madame Lagarde. The environment's been so crazy in terms of COVID, incredible inflation, now a rapid drop in inflation. It seems to me it's a bit foolish to think the exit's going to be smooth. We expect a lot of bumps. So the Fed's confidence interval has to be really wide right now. Can't tell.
So, Mike, as you know, the market's at 6 cuts. The Federal Reserve is implying 3, and I say implying 3, it's based on the median dot, which, as you know, means a lot of things to different people. Mike, I just wonder from your perspective, looking back at history, how likely is it that you go one or the other once you start cutting interest rates?
Yeah, the history is really compelling, John. We've done a bunch of work on this. My colleagues on the FX side have done really a great job. And when you look at cycles by whether it's the Fed, the ECB, BOE, take your pick. When a big central bank starts to cut, it cuts a lot. So 200 basis points plus in the first year, that's very common. And now we've got a fairly high rate environment. It might be more than that. So it seems to us that when the Fed does launch that first move, let's say it's middle of this year, the markets at that point should price at least 200 basis points of cuts over the next year. Right now they're priced for about 130, 140, too light. So the idea that the Fed goes a little bit doesn't make a lot of sense.
So, Mike, where does that leave your projections for year-end based on what you just said?
Yeah, we're modestly bullish, John. So we've had a pretty wild run, I suppose most people have, in terms of being bullish too early. It's been kind of okay the last month or so. But as far as year-end, 10-year Treasury, call it, 350, pretty wide band around that. I think a decent amount of the work gets done by March, so maybe 375 over the next quarter. So a fairly modest drop. But again, like the Fed, like the policymakers, I think you have to be humble and say lots of factors can intrude on that forecast. So that's our base case, but lots of risks around it.
It's a forecast.
So modestly bullish.
With a very large caveat and a big asterisk. Mike Schumacher, thank you, sir. Appreciate the update. Mike Schumacher of Wells Fargo. It's so difficult to forecast this market, TK, right, even a quarter out. 375, by the way, the call from Wells.
That was brilliant in its boredom. I loved what he said about we're still within the thrall, including bankers, including Lagarde, of the pandemic. And I think that's been underplayed over the last number of weeks. But what I heard there, John, is what I'm going to call a single-digit conversation. Mike Schumacher saying, you know, there's all this TV and radio inflammatory discussion. We believe. And what Mike Schumacher's saying is, you know what? Steady as she goes, and it's a time to garner single-digit returns this year. That's what I really heard there.
If you are just joining us, welcome to the program. State of play. Scores look like this on the S&P 500. Equity futures negative 0.2%. 0.24% lower on the S&P. Yields higher by 3 basis points or so to 399.75, and crude up by 3.6%, 3.5% at the moment, 74.53. Tom, you asked this question just moments ago, so we've just got some comments from the Pentagon spokesperson.
Well, they were listening.
Defense Secretary Lloyd Austin actively engaged in overseeing and directing operations. Lloyd Austin gave the order to conduct yesterday's Red Sea strike. So the Defense Secretary, Tom, you wanted to know, is he coordinating this? Is he active? Based on that information, he is.
People think Anne-Marie Horton just shows up. But basically, she, and you know, I'll give Sonali Basak the credit. The moment they step off set, they're glued to their phones working their sources. And Anne-Marie Horton reported that the secretary was actively involved.
That's the latest from Washington and the latest on the Middle East. Coming up later this morning, 8:30 Eastern Time. PPI data drops, Mohammed Al-Arian responds of Bloomberg Opinion and Queen's College Cambridge. That conversation in the next hour.
Have you thought maybe I should go do something else? I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Right now, the NFL Sunday Ticket is a big area of focus for us. And again, as I said, getting that viewer experience right, making that game day experience on Sunday flawless and seamless. And you should expect from us a lot more innovation there in terms of products, in terms of creator integrations, all the things that our fans, especially younger fans of the NFL on YouTube, expect. You should see more of that through the season and in the many seasons to come.
The fans are tuning in. That was the YouTube CEO speaking back in October. Since then, the NFL reporting its best rating since 2010. 93 of the top 100 TV broadcasts last year, NFL games. And it's not just YouTube. Peacock getting involved this weekend, set to broadcast their first playoff game. The NFL signaling a shift away from linear TV. Michael Nathanson and Moffett-Nathanson weigh in, writing, quote, where the history of linear TV has been written, a sad and sorry chapter will be dedicated to how such a once great business was supplanted by a model that wasn't nearly as good for anyone. Michael, I'm pleased to say, joins us right now. Michael, great to catch up with you, sir. Let's discuss it. Let's talk about the sport itself, the dominance of football in this country. What's everyone else getting wrong?
American football.
Yeah, American football. What else is getting wrong? It's a perfect sport for TV, right? You have a set of games, very predictable every week. It's a short season. Every game matters. And sports gambling is growing very quickly. So it's a combination of it's easy to watch. You can bet on it. And we have national storylines, right? The teams are now nationally followed in a way that when Tom and I were younger, that wasn't the case. It was a regional sport, but now it's national in terms of fandom.
Mike, I was watching reading Digiday, I should say, about the complete total dominance of Mr. Moen's YouTube. And I'm absolutely you've been so far out front on this with Craig Moffett. Is anybody down the road going to compete with the two consolidated giants, YouTube and Netflix?
Amazon. So it's interesting. People have always said content is king. I think the past decade, what we see now is the platform is king. And I put Amazon, Netflix, and YouTube as the future leaders in this industry,
right?
Current leaders in the future. And the challenge for media companies is how do you play in that world, right? How does your content resonate in a world where you have these massive platforms with so much choice? And this is the challenge next decade.
Michael, we got to make some news here, so let's get to it. It's a Friday. We need Nathanson news right now. Paul Sweeney modeled out yesterday the idea of ESPN with a 40% lift, I believe, in expense they have to pay for all this sporting activity. Is Mr. Iger setting up ESPN for an immediate sale to Amazon?
You know, he has floated the idea of finding minority partners. I don't think he wants to give it up at this point in time. He's floated partners from the platforms, from the leagues, maybe some other third parties. I think Disney wants to be in the sports business, and they just want to find some funding to help them get through. We have wondered for a while now how ESPN is a better business going forward than it's been. Costs are rising, cord cutting continues to slide. So we've been writing lately, and we started with this a couple of weeks ago, Tom, with you, is that we think streaming, and they've not had a good streaming run here, but they need to focus more energy on streaming and less on ESPN. And we'll see if they listen to us.
This to me is like the interview of the year, John. It was Daniel Levy and you in London. And at the end of that interview, I was standing there, folks, off the side having a pre-cocktail tang. And the answers, John, is he said, well, we don't really want to win. We just sort of want to compete and have a good entertainment. I'm not hearing that from Nathanson or Iger. It's totally different over here about winning.
Let's talk about the sport. Michael, how do you break it? I think you break it by airing playoff games on streaming platforms that people don't have. I asked my producer, Jamie, this morning, simple question.
Do you have a producer?
Jamie. Jamie's fantastic.
How come you have
You don't get to share it. I turned to Jamie, Michael, and I said, how do you watch the football? When's it on? And he gave me an answer immediately. I said, how do you watch the baseball? When's it on? Couldn't answer the question. He's a basketball fan. I said, when's the basketball on? How do you watch it? Couldn't answer the question with a direct answer. That's the problem for all these other sports. And a great example of that is boxing. They have killed boxing. This used to be something everyone used to watch together. It's not anymore. It's buried on a streaming platform, whatever it's called. I don't know. I like boxing, and I don't pay to watch it. Michael, are they about to break it? You talked about the loss of the experience, and I'm with you. They're killing it. They've got success. Are they about to break it?
Yeah, John, I'll break news on the air with you. I totally agree with you. It makes me so angry as a consumer and an analyst that this playoff game is probably the top game of the weekend, right? And when I saw the schedule when it came out, I'm like, wait, they're putting the Dolphins Chiefs on Peacock, so we have to pay $6 more a month to get it for one night. That's just outrageous to me, right? It just is, and I think it's greedy, and I know why Comcast is doing it in Peacock. I think the league is overreaching here, and they've done an amazing job navigating the entire fragmentation of media. But I think you're right, John. I think there's a feedback loop which says these guys don't care about the fans. They're in it for the money. And it's just loud and clear by having the best game of the weekend on Peacock. And I totally agree with you.
Michael, is this because the numbers simply don't work? I've heard TV executives talk about this. The problem with sport is that you build out the asset, but you never own it. You have to lease it. You get a 4 or 5 year deal. I just wonder whether the numbers really work anymore. It was always about grabbing that appointment of view. There were very few left. Let's go to sports. Live TV, all that's left is sports and this right here, broadcast news. Michael, I just wonder the future of that, given how much the asset now costs.
It was interesting, John. When you had 90 to 100 million homes in America, it was a great model. But as homes start to slide, the cost of sport keeps going up, and the cost of the revenues keep coming down or flattening. So it doesn't work for every sport. The NFL is key because for 5 months out of the year, it maintains the pay TV bundle. That is the different sport, right? Hockey, as much as I love hockey, is small. Baseball's become, a small sport in America, but the NFL and college football are different. I think those two models hold for the time being. For the time being, right? They hold.
Michael, you and Craig Moffett on the high ground on predicting that we would cut the cord. I'm going to give credit also to your good competitor, Rich Greenfield, for being out front on this as well. I want to talk about the new cord cutting, which is the churn. Model a 6% churn and what that means for finance of our entertainment. To me, that's a ginormous number because I think over 36 months of business plan that you lose 18% of your people. Am I right?
Well, yeah, Tom, the churn is actually 6% a month for some of these services. So think about that, right? So in, over a couple of years, let's say a year and a half, you can churn your entire base out. The streaming model does not work as built today. That's where you're seeing all these bundles come together because, and Craig's been on this from day one. There was nothing better, 20 years ago, there was nothing better than the pay TV bundle because you didn't have to compete for customers. The customer was given to you by the cable operator. You just had to make one good show a quarter to get paid by the cable operator. In this world, you need a constant hit cycle, and it's impossible to do. So it churns off the charts. The model, Netflix has surprised me. We've been a bit of a doubter on Netflix's model, but it's just worked their way so well. The number 2 position is not very pretty. If you look at Disney in terms of the economics, they lost $2.5 billion last year. You need to cut churn, and the only way you cut churn is by bundling with other people or seeing competitors die. That's where we are.
I know your single best buy is the New York Yankees with Juan Soto. What a gift that is. But in the stock market, Michael Nathanson, what's your single best buy right now?
Well, it's funny. Our single best buy is actually a short call on Roku. So, we've been very, very aggressive on Meta and Alphabet the past 15 months. So we still like them, but it's getting harder and harder to see it was a home run a year ago. We were saying that. In media, we've been buying Disney, but for Disney, I feel like the pressure's on them to now prove the case for streaming, right? So our best call is shorting Roku here, which is, a call on the state of streaming, right? That's the call of the year. We do this every 6 months. We update our call. Today, for me, it's Roku on the sell side.
Love this. Michael, let's do this again soon. Michael Nathanson there of MoffettNathanson. Thank you, buddy. Appreciate it. TK, when this all started, it was meant to benefit the consumer. And you have conversations like that, you just get the feeling people are increasingly frustrated with the direction of travel.
2 of the gifts I've had, folks, over the last couple of years is young Pharaoh saying to me, hey, stupid, follow Formula One. And the other one was following the Tots. They just brought a Romanian. They sent the fullback who couldn't do it to Germany.
Did you send the scouting review?
To see Kane. You interviewed Daniel Levy, and guess what? Nobody's whining. They go out, they play.
Yeah.
They go, the clock moves, and it's over, and you go home, unlike the NFL forever. The Chiefs thing this weekend is absurd.
Agreed. If you want to kill a sport, hide it on a streaming platform.
Yeah.
One of my greatest advantages, I own my company 100%. No board of directors. I make a decision, we move. And I had a guy say to me, runs a big media company. This guy ran a major division, Warner Discovery. Okay. It was just Warner Media at that time. He says, you know what, when we sit in our meetings, we don't talk about Disney. We don't talk about Paramount. We don't talk about Sony. He goes, you know who we talk about? I go, who? You. I said, really? He goes, yeah, you. I go, why? He goes, we are giant battleships, and you're like a little speedboat. And if there's gold on the beach, you run rings around us, get to the beach, take the gold, and by the time we turn our battleship around, you've already taken the gold. I go, that's right. I'm always gonna be that entrepreneur. I started my company from my dining room table 30 years ago. 30 years ago. And I started by calling every television station asking them to carry my once-a-week show. On average, they all said no 50 times, and I worked through about 50,000 no's to get 150 yeses. That guy that was at that dining room table trying to pay his phone bill is that same guy today, 30 years later. That fire is still in my belly. I still run scared, and I'm still running after that vision of building the world's biggest media company.
I brought too many brooms. I didn't forget Catamine.
I think this will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears. Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg.
We feel pretty good about the year ahead. We're looking for broadening.
The trend is in the right direction, and that's the key for the market.
We don't need to run the risk of tipping the economy over.
It's hard to say the market really reflects that anxiety.
The economy is actually doing great. It seems like the whole soft landing is happening.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Bloomberg Surveillance from New York, and it is a day of big bank earnings. We've seen that out in the compare and contrast, as Sonali Basak nailed. JP Morgan, 1.72 is their book value. Citigroup, last in line, 0.52. John Farrow picks up the pieces from Jane Fraser. She's got a wall to climb.
She does, and the stock has been rallying in anticipation of a year ahead and a new strategy. We are higher by more than 30% since October. The stock is lower this morning by 2% with the numbers. Here's Sonali Basak. Hey, Sonali.
Very simply, John, we're looking at that fourth quarter revenue line, the very top line. We're looking at the miss on expectations. Investors expected them to bring in $18.7 billion. They brought in 17.4. So that is the top line number there. We are making it through the numbers here, but even returns on equity as well. You're looking at the fourth quarter come in just a little above expectations, or sorry, below expectations. They're negative. In the fourth quarter. They were expected to be positive. So again, this was a kitchen sink quarter. Investors had known that about Citigroup. So what we're going to see for the next couple of hours is a few things. What are all of the costs tied to restructuring? We already know there were costs tied to extraneous items in different parts of the world, parts that are largely exiting. This is Jane Fraser's year. This is the year she has to bring the turnaround story to Wall Street. And remember, we have to see what that is in terms of those markets and investment banking businesses, in particular, core Wall Street.
The fourth quarter was very disappointing. Not my words, the words of Jane Fraser, the Citi CEO. The fourth quarter was very disappointing. Revenue coming in at $17.44 billion, the estimate 18.68. Sonali, as you know, investors won't pay as much attention to this because these are yesterday's results. We want tomorrow's off the back of the changes they've made. What kind of changes have been made in the last 12 months, and how quickly will we see the results of them?
Project Bora Bora. This is the project that they have that is eliminating layers and layers of management. Jane Fraser, we know, inherited a bank that was bloated, that had regulatory issues, and that had many layers of bureaucracy that she is now taking an absolute axe to. Investors have largely rewarded her moves to do that, though it'll take a minute to get through all those layers of management. Now, again, that is the fixing story, but where does she get competitive in those Wall Street businesses? And also, I'm looking at cost of credit as well. Remember, Citigroup's cost of credit rose to $3.5 billion in the fourth quarter. Right. It was 1.8 the year ago.
To her great credit, she puts the ugly ratios up top. Return on common equity is single digit 5% versus 13, 14, 15% for more successful shops. Let me ask you this, in 6 months or in 6 years, is Citigroup still a big bank?
Yes, but even just this morning I was taking a look at just how much JP Morgan has broken away from the pack. What is big anymore? I think in 10 years you have to ask yourself, are these 6 banks as competitive with each other as they are today when you see the biggest of the big breaking away? Citigroup has won on being a big global bank. The most profitable and exciting, if you will, business they have is their Treasury and Trade Solutions business, which really makes its money from global internationals. But as we've seen from the losses they've taken tied to Argentina's currency fluctuations, operations that were tied to Russia, again, largely businesses that they've exited, it's hard to be a big global bank.
Shanali, stay close. More to come from Shanali Basso to wrap up these numbers. We'll give us some more time to go through the earnings release. Tom, Jane Fraser at Citi, not dressing it up, been quite blunt about it. Fourth quarter was very disappointing. The wealth business isn't where it needs to be. That's the tone from the Citi CEO this morning. The stock turns around just a little bit in the pre-market, now higher, TK, by 2.3%.
Absolutely fascinating. Let's dive into this. Ken Leon joining us with expertise 60 minutes ago and reappears with CFRA, their Director of Equity Research. And he's familiar with a 10-to-1 reverse stock split in 2007-8, which is our Citigroup maybe, was repriced from $40 down to $4 per share. Ken Leon, let's just cut to the chase. Is Jane Fraser going too slowly?
Jane Fraser has no choice. She has a monolithic bank that she's trying to streamline to be a very different bank in the future. And by doing that, I think the story that hasn't been told is that key talent is looking over their shoulder whether they have a job or not, or whether how much risk they should take, whether it be in investment banking or trading, their key talent. The strategy is going to work, but it's going to take several years. And I think to the prior discussion, this will no longer be a leading global bank, but one more akin to a custody bank, like a Bank of New York Mellon.
That's right where I wanted to go. Thank you so much, Ken Leon. And that it goes back to culture and character. My first checking account, John, was with Manny Hanny. And when you said Manufacturers Hanover, that meant something. So what's Citigroup look like in 5 years? Is it BNY Mellon? Or is there a better analog out there that we can look to?
I think clearly it's going to be where they have durable businesses with recurring fee income. That will be in treasury services. It will be in wealth and asset management. They will also try to play a role with catch-up with asset management and wealth. But it's really an enormous competition for Jane Fraser. And again, I think as we go through 2024, every quarter is not going to be in a linear fashion of improvement. There will be some issues that do come up. They couldn't even sell Banamex in Mexico. That will be an IPO in 2025. The analysts generally are very positive about Citi. I still look back to Wells Fargo with Charlie Scharf, and that took 5 years to really get to where they are today. So I think it's the right strategy, but I think there's a bit of optimism of how well this will work quarter to quarter in 2024.
Ken, you hit it. How big will the big bank be? This from Citi, seeing a net reduction in headcount of 20,000 over the medium term. Shanali, I'm sure that's a number that jumped off the page for you as well. Is that what you were expecting?
In line, yeah. I mean, we knew that it would be tens of thousands. It's nice to get a head count number here because they had been holding off on giving the full extent of what we would see here. It is in line with what we were expecting. Now, how much it's going to cost them is something we'll look at as well. This was going to be, we call it kitchen sink quarter, right? I mean, they had a lot of charges that they're going to have to announce and work through for those headcount reductions. If you wouldn't believe it, they had among the biggest of headcounts of the top 2 banks. I believe that they were even over Bank of America. So they had a lot of room to cut, as painful as it is.
Ken Leon, let's talk about what this could all mean for capital returns. The latest from Citi is we'll continue to evaluate buybacks quarter by quarter. Can you take us across the industry right now? Given everything we've been discussing, what do capital returns look like?
Capital returns as it relates to from the operating part of the business is good. And we will see overall, 12, 14% returns. Clearly, JP Morgan Chase is well above that. But it's the risk of capital build with tighter bank regulation. Capital build means that the banks, even on generating strong returns, will be mindful in terms of higher capital requirements and the restraint it will have for dividend growth and buybacks. That's Basel III endgame. It's going to be really a delicate dance for the large banks, not to really oversell how well they're doing, because on the back end, regulators both in Europe and US, they're concerned about the black swan, whether it's Credit Suisse or other episodes in the past. And that means some of the higher return areas, such as in the derivative trading, the banks are going to take less risk and hold on to more capital.
Is Citigroup's, I got to make some news here, Ken. It's a slow Friday. Ken Leon, is Citigroup so challenged that what we're looking at out 12 or 24 months is a merger of one of the super regionals with this big bank Citigroup that's not a big bank anymore, where they wake up the next day and almost like, a Swiss bank and UBS, whatever, years ago, all of a sudden the next day they're a big bank again. Is that where Jane Fraser's heading?
I don't think it's with the regional banks, because they have plenty of deposits and loans. I think it's the non-banking areas of services that really matters to them, and fee income. And that's why I mentioned Bank of New York as one example, where they have durable businesses, but they don't get higher multiples, Tom. You really are moving away from perhaps the higher return, higher growth areas, but they know they have to get away from the cyclicality of being a bank, because you don't get rewarded.
Ken, there's a few big names left for next week. It's Morgan Stanley, it's Goldman. Can you take anything from this morning and apply it to those names next week? What would you expect?
I think 2024 is going to look good for investment banking. The numbers, though, will suggest that it won't be V-shaped, but I can assure you that there will be plenty of activity in equity and debt underwriting and M&A. The alts, there's only about 2 analysts on the street that cover banks and the private equity firms. I'm one of them. There is an enormous backlog to monetize these, and Goldman Sachs and Morgan Stanley will be there to help execute on that. The other story, which is for another day, is the shift of lightening up the balance sheet and loans and moving over to private credit. So again, all the attention is on the large banks, but when you look at Blackstone, Apollo, Ares, and others, they're in a pretty good position.
Hey, Ken, appreciate the update and the help this morning.
Great.
Ken Leon of CFRA. If you are just joining us, welcome to the program. I'll give you the state of play on the banks first of all. JP Morgan positive in the pre-market by a little more than 2%. Their outlook for net interest income better than expected. Citi, Tom, turns around up by almost 3%.
Yeah, Mike Mayo looking like a genius. 41 up to 53 on Citigroup. I guess that's the beginning of a move for this year. John, what I would emphasize there in all that tumult and that turmoil is Jane Fraser, the execution of this down Lexington Avenue. I'm fascinated by the immense pressure to get going, and yet Ken Leon saying, hey, Tom, you're an amateur. It's not that easy.
You mentioned Mike Mayo of Wells Fargo looking for that stock to maybe double, Tom, over the next few years, which is quite amazing. Citi up by 2.75%. The broader market equity futures right here on the S&P 500 slightly negative, down by 0.27%. Yields are higher by 3 basis points, 4% on a 10-year. So much more still to come this morning. PPI data. 8:30 Eastern Time. Reaction to it with Mohammed Al-Arian of Queen's College, Cambridge. A must-watch conversation in the back half of this hour. Charlie, before you go, you've had some time to pour over it. What's the big takeaway from this morning?
The outlook. We've said that this was going to be a kitchen sink quarter for Citigroup, but she wants to grow the revenue by $2 to $3 billion, and she wants to shave off tens of thousands from her headcount. Medium term, she sees it being about 180,000, which is remarkable. That could signal more job cuts ahead. This will be a much smaller bank, to Tom's point, and if you look throughout the entire banking system, the margin at which JP Morgan is expanding over everyone else is remarkable. Right. They brought in $10 billion more net interest income than Bank of America alone.
Quickly, and this is what you're best at, the cultural shift from Sandy Weil, Travelers, Citigroup, over to what Ken Leon said is this is the next BNY Mellon. I can't frame that culturally in New York.
The financial supermarket was Sandy Weil. Focus is Jane Fraser. That is the simplest way to put it. This will be a smaller bank with more defined business lines, with more accountability on every single person in that bank.
Shanali, absolutely excellent as always. Shanali Bassett, thank you. More from Shanali through this morning, through the day, and into next week as well. Earnings still to come next week from Morgan Stanley and Goldman Sachs. In your equity market, S&P 500 futures negative by 1/3%. Crude 74.30 on WTI, up by 3%. Brent crude briefly in the 80s, 79.80 right now. Victoria Fernandez across Smart Global Investments up next from a beautiful New York City. Good morning.
City.
From London, in Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
I can't type.
There are a lot of rate cuts that are priced in the near term, starting as early as in 2 months from now, that may not come to fruition. I mean, the Fed is good at waiting and watching and lagging, right? They lagged on the way up, and they are probably going to wait too long and keep rates too high for too long before they cut, and then they're going to have to cut more aggressively.
There was a real shift yesterday from Michael Collins, fixed income senior portfolio manager over at PGIM. He's been constructive on credit for a while. He's not anymore. He's been reducing risk. And when we asked him why, is it about price or fundamentals, the story or the price of the story, he said the price of the story. TK, spreads just getting too tight over the last few months.
I can't say enough about PGIM across the Hudson River. They picked up Tom Porcelli as well this year for economic wisdom. But I thought that interview was great with Michael Collins about just grab the coupon and don't overthink. Now, where you are in duration and how far up, but that was a real clarion call of grab the coupon and don't overthink about Jerome Powell.
That was CPI Thursday. This morning is
ancient history.
PPI Friday. PPI data in about 13 minutes' time, TK. Mohammed Al-Arian just around the corner.
Right now we're going to get to it, and we can dovetail in here the bank earnings that we've seen. We do this with Victoria Fernandez, Chief Market Strategist at Smart Global Investments. Victoria, I had a wonderful interview with Sandy Weil a long, long time ago. And he was reminiscing about the roll-up that became Citigroup, Travelers Insurance, and all that. And I want you to deal now with the magnificent 7 of what happened 20 years ago or 30 years ago, where somebody out there said, we should buy and hold Citigroup. And that didn't work out. How do you handle buy and hold if you know there's a next Citigroup out there?
Yeah, I'm not sure I have the perfect playbook for that, Tom, but there are names that we have in our portfolio that they're going to have the volatility around them. Apple's a perfect example. Microsoft is a perfect example when you talk about some of those Magnificent Seven that we do see as buy and hold in our portfolio. It doesn't mean you can't be a little bit tactical, right? We've talked before about how you trim names on up days. You can go in and add a little on down days. So you can have little tactical moves, but overall, you want to hold some of those positions for longer periods of time for these companies, and they've proven themselves over and over. Their balance sheets look good, their cash flows look good. So I think you're going to have some of that, and some of these Magnificent Seven names will be those names.
What are you learning from your Crossmark accounts about cash? They must still be in cash at 5%, but are they ready to move if they see a lower yield?
Yeah, it's interesting. We have seen some movement from cash. When you look globally, it's moving into equity ETFs. We've seen quite a bit of our clients actually moving into our balanced portfolios where they do a 50-50 equity fixed income. They want to have some of that fixed income exposure. Look, we've talked about the rates that you can get on fixed income. You guys were just talking about clipping the coupon, not worrying about what Powell says on that. And there's definitely some positive news that you can do for your portfolio by doing that. So we're seeing cash being put to work, both in equity, both in fixed income, and in our covered call writing strategy, our option strategy. People are looking for ways to generate income. Fixed income and options is a great way to do that for our clients.
Cover call writing, are you trapped there if we get another 2023 where everything's taken away from you? I get the game, you get a premium, you get a yield pickup. John, we use this in the triple leveraged all cash all the time.
How's that working out?
It worked out great last year, but come on, you're going to get another lift in the equity market. Does covered call writing work?
It does work depending on how you're writing those, right? So if you keep them short, 30, 60, 90 days at the most is what we're doing right now, and rolling those over, you may lose a name here or there, but it's been a great option for our clients generating double-digit cash.
What you just heard there, folks, is gospel, and let me rephrase this for the delicate Ms. Fernandez. Don't be a pig. Because what you do, John, is you go out with covered call writing and you go, I can pop out 12 months or 18 months. I'm going to be a genius. And then, oops, they take Apple away from you.
Let's talk about
not a good
Apple.
idea.
Earnings, early February. Let's get into it. Victoria, who's got pricing power at the moment?
That's tough, Jonathan. You know, when you look at corporations as a whole, they are losing some of that pricing power. As you have the disinflation come in, as wages continue to stay high, these companies are losing their pricing power. We think it's going to affect margins across the board, and that's going to be one of the key themes for this earnings season. It's one of the reasons we think the market is probably going to have more of a pullback than what we've seen so far. But look, when you talk about Apple, we know that ecosystem. I can probably count 3 or 4 Apple items surrounding me right now in my home. They've sucked me in and I'm in there. I'm paying for the services. So once they get you locked in, that pricing power is there for them. So when it comes to Apple per se, I think they're probably better off in that category than a lot of other more global companies, especially like consumer companies.
Victoria, a thing that's out there is healthcare stocks. This is a year because last year wasn't the year. Everybody said healthcare, United Healthcare, all the rest, Danaher, et cetera, are going to go. When do they go? What's the catalyst to make healthcare finally win?
Yeah, you know, healthcare is a tough one, Tom, in an election year, right? Because there's a lot of volatility. But there is some opportunity here. Cigna, we own in our portfolios. It's one of our favorite names for this year. They were so beaten down over the last 12 months, but their balance sheets, you know, we always come back to balance sheets, are looking pretty good. So I think you can dip your toe in some of the healthcare names, put them in your portfolio, let them ride a little bit. You will have volatility as we get talk around election into regulation and pricing of drugs and different things, but we think you can have some good upside opportunities here. Like I said, Cigna being probably one of our favorites.
Victoria, everything said and done about this year was the shock of how everyone was wrong last year except Victoria Fernandez. It's not going to be, I mean, we just heard this from Mike Schumacher at Wells Fargo, John. It's just not going to be that easy this year. So what's the strategy month by month for retail who just, you know, they own whatever they own and it went up beautifully last year? It's not going to happen. So where are you in March and April with your accounts to say patience?
Yeah, patience is a wonderful keyword for our clients to have, but it's also diversification. And we don't just mean your general diversification. We mean go in, do your homework, dig in there. Where do we see opportunities? There's some names within the staples. If we're going to be a little more risk off, add a little bit of your staples name. We like financials. Obviously, banks reporting today. We think there's some upside there. JP Morgan being our favorite. Add some financials. We know the consumer at some point is going to get squeezed a little bit, so that risk-off component is in there. Have some fixed income, as we think yields might move a little bit higher as the market prices out multiple cuts that are in there right now. We just don't think the Fed is going to move as much as they are. And we also like to put a little bit of our equity market neutral strategies for our clients, an absolute return strategy to just kind of even out their portfolios.
Victoria, thank you. Appreciate the update from you and the team. Victoria Fernandez there of Crossmark Global Investments on earnings, on the equity market, on fixed income as well. Something from Boeing, or rather on Boeing right now. Check out Boeing and Spirit AeroSystems in the pre-market. Boeing is down about 1.8%. This is the latest. The FAA says it's conducting audit of Boeing's 737-9 MAX production lines and suppliers to evaluate Boeing's compliance with its approved quality procedures, according to an emailed statement. TK, results of the audit analysis will determine whether additional audits are necessary.
You're talking real standard deviation moves where it unravels. Support here off of October of this year is at 180. We're at where are we? 218 right now. So we got room to move to get back to where they were before the bull market boom of just, a cup of coffee ago, 4 months ago.
You wanted to know how quickly the 737-9 MAX would go back into service fully, Tom. The FAA says safety of the flying public, not speed, will determine the timeline for returning the Boeing 737-9 MAX back to service. TK, some people were talking about maybe in a week, but based on what we're hearing there, who knows?
Well, you can make jokes about it, but there's nothing funny here, and the FAA is stepping in. I should say they're also stepping in with a new leader who's got to prove himself and be visible on this. And I really, I'm going to leave it up to a pro like George Ferguson or some of the great Helene Becker and Steve Trent and the others to tell me, so what do? You wheel the airplane in Newark, you jack it up on the runway. What do? Check every rivet? I mean, how does that work?
Boeing's down 2% in the pre-market. Coming up on this program, economic data, reaction to it. PPI just around the corner. Mohammed Al-Arian of Queen's College, Cambridge, with us for the next 30 minutes to close out this hour and this show. From New York City, this is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one. Okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment case for this in the world.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
We had CPI yesterday. We've got PPI this morning to round out economic data for you. That data is about 20 seconds away. Here are the scores going into it. Equity futures on the S&P 500 look like this. We're negative by 0.3%. In the bond market, yields are a little bit higher by 2 basis points on a 10-year. Just short of 4%, 398.99 on a 2-year, higher by 2 basis points to about 4.26. With the economic data, let's say good morning to Michael McKee. Morning, Mike.
Good morning, John, and good morning to everyone out there with some good news on inflation. After yesterday's higher than expected CPI, we get a lower than anticipated PPI. PPI for final demand down 0.1%. The forecast was for a 10th gain, and last month it was completely flat. The core ex-food and energy is flat, and that was expected to be up 0.2%. And ex-food, energy, and trade, which is kind of really the important core of this number, up 0.2%. That is on expectations and a little bit higher than we'd seen. So for the year-over-year number, PPI goes up to 1% from 0.9%, core 1.8%, and the ex-food and energy and trade stays unchanged at 2.5%. Now, everybody says, does this mean good news for the future? There's not a direct correlation between the two, but PPI has been falling faster than CPI, so we shall see. Now, the important thing to note is there are a number of categories within PPI that are used by economists to figure out what PCE is going to be, used by the government as well, including healthcare data. And so if we're basically in line here, it probably means that PCE is going to come in lower than CPI.
And John, the revisions of PPI out seconds ago are also diminished over what they were 30 days ago.
Mike said it was good news. The market seems it the same way. Let's go through the boards. We'll start with equities, then to bonds, and then we'll get to foreign exchange. Equities turn around just a little bit. We're well off session lows. We're still down a touch on the S&P by almost 0.1%. After that, into bonds, yields were higher. Now they're lower at the front end by 2 basis points. Your 2-year is 4.22. And the dollar, the euro against the dollar was negative. We're just about unchanged now, 109.68. So the dollar giving up some of that strength. Mike McKee, you caught up with the Redemester of the Cleveland Fed yesterday. March is too early. Is that the Cleveland Fed view or the view on the FOMC?
Oh, I think it's a much wider view than just the Cleveland Fed. They're going to want more data. Obviously, we could see some big change in the data, but the data that we have been getting kind of tells the same story, and so they don't need to cut in March, and unless the economy slows significantly, they probably won't. But it does set up May. Let me just note, this is a services story in PPI today. Final demand services unchanged. Final demand goods fell 0.4%. That continues a long trend. And the one thing that went up is the thing that's been going up for quite some time, and that is securities brokerage, dealing, and investment. That increased 3.3%. The fees you're being charged to trade.
That's John Day trading Bitcoin.
It is kind of an interesting point to make on a day when bank earnings are coming out.
I want to squeeze this in before Dr. Alarian. Ed Yardeni published late last night and made real clear ex-shelter inflation is disinflation. there's no shelter in PPI. So does this quiescent report suggest Yardeni's right, that basically there is disinflation in place, except for some shelter statistic?
In a general sense, yes, it does. And it suggests that we're going to see continued improvement in inflation, but how fast is the open question. Before we go to Mohamed Al-Arian, I have to take a moment and congratulate him.
Oh, wow.
Because we've been talking about this for a long time. He's the man, if you're an NFL fan and you don't like the New England Patriots, the New York Jets are the team that not only does Mohamed follow, but they're the team that drove Bill Belichick out of the NFL by defeating him last weekend. His last NFL game, until maybe he gets another job, is a loss to the New York Jets.
I'm about to offend Jets fans across the city, so forgive me ahead of time, but that does speak a lot to where the New York Jets are at, that's like the big defining moment of their season.
Well, I would bet you that Mohamed is sitting there probably with a glass of champagne because it is important.
Can Belichick coach the Jets? Why not?
He already quit that job once.
Okay. We are going to turn now to Mohamed Al-Arian at Queen's College, Cambridge, and it is on economics, finance, and investment. But today it's on something different. After the attacks we saw overnight against Houthi rebels and terrorists, and of course their relationship to Iran. Mohammed, this goes back to Albert Harani and what we all learned about the history of the Arab people. Bahrain is one of our allies here. Would you suggest that the Arab nations are in support of this allied attack on these rebels?
I would suggest they're nervous. You saw a statement by Saudi Arabia that is warning against escalation. And the concern here, Tom, is that other proxies, other Iranian proxies in the Middle East will see this as a reason to escalate what's going on in that region. So that's why you hear concern from the Arab countries. The last thing anybody wants is an escalation that becomes region-wide.
Which institution can create a dialogue between Tehran and a Western world worried?
I think first you need to see a cessation of hostilities in Gaza. That is a precondition. There won't be the ability to get people talking in a broader sense in the region until you get a cessation of hostilities in Gaza. Once you get that, then you know that the relationship between Saudi Arabia and Iran has improved. You know that the UAE plays a critical role in conversations among countries in the region. So there are parties that can help, but you need the precondition first.
Mohammed, you warned in Project Syndicate recently not to extrapolate out the favourable trends that we finished last year with. Is there something that's developing in the Middle East right now that you think is a direct threat to that?
It's one of the things, John. I mean, my major concern is that if you look at the three systemically important regions in the world, economically, the Eurozone, the US, and China, all three are having issues growing in a robust manner. The US is the exception there, but even the US now is facing lower household savings, higher debt. China needs to fundamentally change its economic models, and we know that without a healthy Germany, Europe is going to struggle. So if you actually look at who is the locomotive of growth, it's very hard to point to one locomotive. It's hard to believe that the US will be able to maintain what was very impressive growth rates. Now, put on top of that the geopolitical concerns, and that's why this recency bias, where people simply extrapolate what was a surprisingly good year from last year, is something that we have to guard against.
So you're questioning the resilient growth story. Are you also questioning the disinflationary trends, Mohammed, that have started to develop over the last 12 months?
Yeah, I smiled when I heard the conversation before I came on, that, you know, it's disinflation ahead. It's not. We're going to see, and we already are seeing, cost push pressures in the pipeline. There's two in particular. What's happened to navigation in the Red Sea is directly and indirectly increasing inflationary pressures, directly by hiking input prices, indirectly by causing shortages that then influence other prices. And then we have the labor market issue. We have higher labor costs coming through the pipeline. So you've got cost push pressures coming in. I suspect we will see inflation at the CPI level get stuck at 3%. And then the Fed is going to have to make a difficult decision, either tolerate it for longer, and I was encouraged by John Williams' use of the word, a longer-term inflation target is 2%, or try to reduce it to 2% too quickly and risk the real economy. But this notion that immaculate disinflation is going to continue is something that I find very hard to reconcile with actual data.
Mohammed, you really challenge that theory. I think that we get a lot of people on this program, and I know you tune in and you've heard them say it, that the economy is rebalancing, this will continue, just give it time, we'll get there. You push back against that. I hear other people say things haven't changed. We will go back to the pre-2020 economic regime, low and stable inflation, growth in at around 2%. You really believe something has changed? What are the issues that you can point to, Mohammed, that you think have fundamentally changed since the pandemic?
So I think it has fundamentally changed since what was before the pandemic. Coming out of the global financial crisis, we had major balance sheet damage, and that resulted in a decade of insufficient aggregate demand. There simply wasn't enough demand in the system. And when there isn't enough demand in the system, you pump in liquidity from the monetary side, from the fiscal side, and you don't have to worry about inflation. You boost up asset prices, and you get some growth response, but nothing really exciting. That was the story before the pandemic. Coming out of the pandemic, in addition to the pandemic disruptions, we have 4 factors that are leading to insufficient aggregate supply. So it's a fundamental change in the macro environment. So what are those factors? We have fragmenting globalization, which means that supply chains are starting to be determined by geopolitical and not just commercial reason. We have companies themselves looking for more resilient balance sheets, more resilient supply chains after what happened during the pandemic. We have a significant transition on climate, and we have the labor market also, where labor force participation has not gone up as much as all of us wish. This is a world in which we are fragile to begin with on the supply side, and then you get the occasional shock. So that is a fundamental change.
Mohammed, I'm not going to be at Davos. I'm going to be watching QPR at Watford this weekend. I'm really looking forward to that.
Mohammed's not.
But I'll be there. Mohammed, if I was in Davos, my banner for the year would be "It's cost of carry Davos." What's fundamentally changed off of your good analysis there moments ago is all of a sudden money costs something. Every single business and family out there has a new cost of money. How's our world going to change a year out with this new after the free lunch of the last decade?
Yeah, and the issue is the legacy of the free lunch. I think on a flow basis, we can deal with the higher cost of money. The problem is the stock. And we know there are 3 major areas that somehow have to be refinanced, and you've got to get volume back. One is the U.S. housing market, where the higher mortgage rate is just stopping people from moving. And it's very hard to get onto the housing ladder right now because you're not getting the flow you need. Second is commercial real estate. There's $1 trillion plus that has to be refinanced, and some of it cannot be refinanced at what is assumed in terms of value. And then the third area that needs to do is we have a wall of corporate maturities coming up in 2025, and companies normally try to get ahead of it. So if we can deal with the stock issue, with the legacy of this borrowing that occurred when rates were artificially low, we can deal with the flow aspect. The flow aspects, Tom, don't worry me. We just have to deal with the stock.
Mohammed, we'll continue this conversation. Do you want to tell Tom about QPR, or should I?
No, I really don't want to get depressed and start crying on
relegation zone, TK.
Really?
Relegation zone.
Can the Jets be relegated? I mean,
they are like the Jets of English football in the Championship.
Really?
Right now. Yeah.
There's a level below them.
They can go down. a leak yet. This is not looking good for QPR.
Well, you know, Mr. Rubenstein's rumored to be looking into Baltimore Orioles. I think
keep saying to Mohammed, I've said to
Professor Alarian, I mean, come on.
If they get relegated, can we get some kind of consortium together and take out QPR?
Yeah, that's what get some movie actor involved that watches us every day. That'd be great.
Mohammed's in the
and
UK
you could do
now.
the Ted Lasso thing. You could go over and do it.
I could go and coach the team or something. I'm not sure anyone at QPR wants that. I'm not sure QPR fans.
I know Mohammed Alarian doesn't
want that
want
either.
that.
Mohammed's going to stick with us, the brilliant Mohammed Alarian of Queen's College, Cambridge, to round out the week, TK. To round out this morning as well. So PPI comes in a bit better than expected. Equities almost unchanged on the session. In the bond market, Tom, yields are a little bit lower at the front end. We're down 5 basis points on a 2-year.
And Boeing struggling as well. Another story tangential after the huge bank earnings report today.
From New York City this morning, good morning.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock.
Yeah.
And that was really smart too because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
When you go back in modern financial history, there's only been one quote-unquote soft landing. And part of our concern right now is that unlike this time last year when everyone thought recession was imminent, no one thinks recession is imminent. And when you think about that kind of drawdown, the average non-recession year drawdown is 13%.
That was Julian Emmanuel of Evercore looking potentially for a rocky path ahead in 2024. The team led by Ed Hyman looking for recession, I believe, in the middle of this year. If you are just joining us, equity futures just about unchanged on the S&P 500, going into the opening bell about 44 minutes away. Yields are a little bit higher on a 10-year maturity, but at the front end of the curve on a 2-year, we're down 5 basis points. PPI a little bit softer than anticipated. Going against the grain a bit with CPI coming out a bit hotter than expected yesterday, but encouraging the view that the Federal Reserve can reduce interest rates sometime soon. We had bank earnings a little bit earlier this morning. Allow me to go through just one of them for you. JP Morgan earnings at this morning, TK, but it's all about the outlook from that bank. The outlook is better than expected, and the stock turned higher off the back of that information. In the pre-market right now, JP Morgan, Tom, up by 2%.
And I would suggest even at Davos with their annual soiree, John, they're going to have to manage the excellence that they've got to underplay profitability, they've got to underplay dominance, they've got to underplay what we see tick by tick, as Shanali said, they stand alone.
It's so difficult to forecast this year. Imagine trying to forecast this year, Tom. The next 12 months. All the elections around the world, the tension in the Middle East, the expectations that the Federal Reserve is going to reduce interest rates 6 times, may well start in March. Got to reconcile a lot of things.
Well, we're going to have to see. We continue with Mohammed El-Arian. And John, this is just wonderful after the accolade he has received from Dubai. and an award given to him for all of his commitment to the Arab world and to economics as well. Dr. Al-Arian's father, the former Egyptian ambassador to France a few years ago. And I guess I could start with Dr. Al-Arian. I know what Dubai was like the first time I was there, Mohammed, and the growth just since I've been there is extraordinary. What was Dubai like the first time you were there?
So that's going to expose my age, but I was there first time in the 80s, and there was nothing there. There was absolutely nothing there. To see what there is in Dubai right now, and it's a combination, Tom, as you know, of vision, leadership, and agility. And those three things have delivered something that is much admired. I was really surprised to learn, for example, that more people go to the Dubai Mall, more tourists go to the Dubai Mall than they do to New York. That's an incredible statistic. I still can't get it right.
How do they sustain the Persian Gulf, and to use a phrase from the British years ago, the tribal structure? How do they get to nation